Hi everyone. When the market gets shaky, investors usually look for companies with steady cash flow, dividends, buybacks, and real staying power. That brings us to AIG today, American International Group. For many investors, AIG still brings back memories of the 2008 financial crisis, a complicated insurance giant, government rescue money, a company that many investors stopped trusting. That image is still there. But today's AIG is very different company. AIG is becoming simpler, more focused, and more shareholder friendly. It is no longer trying to be a complicated financial empire. Today, AIG is becoming a focused property and casualty insurance company, and this change is starting to show up in numbers. Before we get started, if you want to keep receiving fast updates on great company analysis, market trend, and investment insight, please don't forget to subscribe. Now, let's begin. AIG is becoming a cleaner company. To understand AIG today, we need to look at what the company removed. In the past, AIG had too many businesses under one roof. Life insurance, retirement product, property and casualty insurance, investment assets, global financial operations. The company was big, but it was also hard to understand. For investors, that was a problem. It was hard to know how they make the money and spending and where is the risk. But AIG made a major move recently. It separated Core Bridge Financial. The old AIG was a large and complicated insurance and financial group. The new AIG is becoming a focused on just P&C insurance company. P&C means property and casualty insurance. This is insurance for buildings, factories, cars, lawsuits, accident, natural disasters, and business risk. This business is about one thing: pricing risk correctly. A good insurance company does not simply collect more premiums. It has to choose better risk, control losses, manage expenses, and protect capital. That is why the combined ratio is so important. Okay, so combined ratio is easy term profit and loss. Great, it is great for insurance company's daily business. It tells you for every $100 the company gets from customers, how much does it spend. So under 100%, it's a profit, it's good. If the ratio is 87%, it means for every $100 AIG takes in, and they spend $87 and keep $13 as profit. This is very good. Over $100 is not good. If it's 105%, they're making they're receiving $100 and spending $105. But AIG's 2026 Q1 combined ratio was 87.3%. So margin ratio was 30%. That is a strong number for insurance company. It is becoming a more disciplined and more profitable insurance company. That is the first major change. Now let's look at the result. AIG's adjusted EPS in Q1 2026 was 2.11. That was much higher than last year. It also beat market expectations. But for an insurance company, EPS is not the only number that matters. The key number is underwriting income. Underwriting income means profit from the insurance business itself. AIG's first quarter underwriting income was $774 million. That was more than 3 times higher than last year. This matters because it shows real improvement in the core business. This is not just a one-time accounting story. AIG's insurance business is becoming stronger. Another important number is core operating ROE. AIG's core operating ROE reached 12.2%. That is close to the high end of the company's target range. This means AIG is using shareholders' capital more efficiently. This is the real turnaround story. The company is becoming easier to understand, the business is becoming more focused, profitability is improving, and capital is being returned to shareholders. That is why AIG deserved another look. Okay, AIG is not a tech company, but the story is not boring. AIG is not a high growth tech company. It is an insurance company. So this is not the type of stock that moves only because of one exciting headline. But that does not mean the story is boring. AIG has a different kind of opportunity. It is turnaround insurance stock with improving profitability, dividends, and buybacks. That combination is very good. They are making money and their business model is becoming cleaner. And now AIG is returning capital to shareholders. The company has been buying back stock. It also increased its dividend. In 2025, AIG bought back about 5.8 billion of its own shares. In 2026, AIG raised its quarterly dividend by 11%. That is important because we are an investor. We want to know if we can make money from investing in this company. Company shows that management has confidence in the company's capital position. In insurance company, capital strength is very important. So when an insurance company improves profitability, simplifies its structure, raises its dividend, and buys back stock, investors should pay attention. That is AIG's story right now. Also, AIG's profit and margin is getting better via AI. They are starting to use the AI for their system. AIG said that in its Lexington middle market property business, AIG Assist helped improve the submit to bind ratio by 35%. That means the how many insurance submissions turn into actual policies. So this is not just an AI buzzword. It can directly affect business performance. AI can also help with claims. Some claims takes forever, but it can become much faster with AI and automation. Over time, this could help lower expenses because they don't need too many claims agents. And if expenses improve, profitability can improve too. Therefore, AI has more room to growing up at this point. AIG is using AI to underwrite better, process claims faster, and manage costs more efficiently. Okay, let's see the competitors. They are strong too. Currently, Chubb and Travelers are two of AI's major competitors. They are larger companies than AIG today, but AIG is now focusing on shareholder returns and strengthening its core business while improving its brand power and margins. Chubb is currently one of the strongest players in the industry. It has strong margins and generates a lot of profit. However, we look at the forward PE ratio, AIG appears to have greater growth potential. This means AIG is becoming a more stable company where investors may be able to benefit from both capital gains and dividends. AIG used to be a massive financial giant, but after nearly collapsing during the financial crisis, the company has been rebuilding itself from the ground up. Building a new company from nothing is difficult, but I also believe it is extremely difficult for a large corporation to lose most of its value and then start rebuilding again from the bottom. It has now been 18 years since the subprime mortgage crisis began. AIG's journey to regain its past strength is not only financially interesting but also a compelling turnaround story. Also, right now, people are very interested in the AI investment and tech companies. But those companies, technology, I'm not a tech person, maybe that's why, but it is kind of hard to understand and we don't know how the AI is working behind. But AIG is very simple. We can see the insurance plan and claims and how the money moves and the cash flows. And then they also reduced their business side. They also trimmed their businesses. So now even simpler business. I think this is great time. If your portfolio is too concentrated in AI stocks or high growth names, AIG is worth taking a look at. It may offer a combination of stable dividend and long-term growth potential as an attractive insurance company. I'm not a financial advisor, and this video is for educational purposes only. There are simply my personal thoughts and opinions. All investment decisions and responsibilities belong to each investor. If you enjoyed this video, please hit the like button and subscribe. I'll come back again with more companies and information that may be helpful for you. Thank you. See you soon.